welcome to Bloomberg Quint Live, and I'm Navneet Saluja D'Souza. Well, we're calling this show Trading via Straddles and Strangles, as we would be discussing these option strategies with Abhijit Phatak of Definet Solutions, who has been employing them for almost a decade. Well, what's been his track record then, and how is his method different from the conventional way? Yes, there's a slight twist here with regard to these strategies, as Abhijit only uses price action before employing these strategies, and he completely avoids option Greeks. So let's check with him the rationale behind this, and also understand the way he trades straddles and strangles. But before I get Abhijit on the show, just a reminder for our viewers, if you have any queries with regard to these strategies, in fact, you can call us now on 022-4540-4141. Write to us on Twitter, Facebook with AskBQ hashtag, and we'll try and get most of your queries answered from Abhijit. Well, let's welcome our guest then. Hi, Abhijit. Thank you so much for joining us here. And the main difference that you've highlighted, I know you've been employing these strategies for almost a decade.
Yeah.
Why are you only using price action and avoiding option Greeks?
There are two things in tracking straddles and strangles. One is the Greeks, which is what conventionally has been used. But when you track it on the basis of the price action, which is the chart, it can be only objective and there is no subjectivity involved. In Greeks, there are a lot of parameters which one has to track, and there is subjectivity in every parameter.
Right.
Whereas on the price, there is only one price on the chart, and that's why it's easier to interpret the price rather than the Greeks. So that is the way I like it.
So you're not going the way of price Bhagwan Che, or
yeah, it's Bhav Bhagwan Che.
Bhav Bhagwan Che, sorry, my Gujarati is not that great. But let's move on and tell you what are these strategies first for the benefit of viewers, and obviously then we'll move on how Abhijit employs them, how he plots them in fact on different types of charts. So Abhijit, to start off with, tell us what a straddle is.
A straddle is, let's say we are talking about a nifty straddle of any strike price, let's say 11,400. A straddle is the call option and the put option of the same strike price of the same expiry. So 11,400 call and 11,400 put is an 11,400 straddle of Nifty.
And what about a strangle? How is that different from a...
Yeah, strangle will be out of the money put and out of the money call. So they are different strike price of the same expiry. So if let's say Nifty is now at near 11,600, so out of the money put is let's say 11,400. So 11,400 put, which is out of the money, and let's say 11,700 call, which is again out of the money. So that together is a strangle.
Okay, so will it be right to say that the basic two difference between straddle and strangle is, in straddle we are using the same strike price, whereas in strangle the strike prices are different, and the other is in straddle it's at the money and in strangle it's out of the money strikes?
Yes and no. In straddle it can be out of the money also. I mean, there can be 11,400 straddle, 11,500 straddle, 11,600 straddle. In fact, that is how I track Nifty and the stocks. By looking at various straddles of different strike prices.
Okay, but if somebody wants to, employ a bearish or a bullish stance while before taking a position, I know there is something called long straddle or a short straddle. Could you tell us what is that?
Yeah, long straddle means buying, let's say we are talking about 11,500 straddle long. That means buying 11,500 call and 11,500 put together at the same time. That is what is meant by going long in 11,500 straddle.
Okay, and what about a short straddle?
Short straddle is going short in both of them, 11,500 call short and short in 11,500 put. So shorting both is shorting the straddle. So
basically in long, we're buying the option strikes, and what we call writing, we're referring to shorting here, both the strikes, right?
And the difference is for buying, you need to pay only the premium. Let's say 11,500 is total is, let's say 130, I'm just guessing.
Yeah.
So 130 is the price you have to pay into 75, which is the lot size, and that's all one has to pay. Whereas for shorting, you need margin which is almost equivalent to futures for both the legs.
So the risk is unlimited when you actually short, and it's limited when you go long. Reason being, you just have to pay the premium on those strikes.
Limited risk, yes, but then it is not always that one makes money in buying straddles also.
Now, I'm not suggesting that. I'm just saying what, limited, we all have been studying, when you look at these option strategies, that risk is unlimited when you short something.
Yes, in a way, yes. Actually, again, unlimited is a wrong word because Nifty cannot go to 13,000
Right.
tomorrow. So there is a limit, but yes, in
But
a
there
way,
are market participants, Abhijit, who also say that 99% of the writers make money in this market and not buyers. I don't know how true is that, but people do suggest that. Okay, that's about long and short straddle, but what about the strangle side?
Strangle again is the same thing. Let's say Nifty is at 11,600. So we talk about 11,400 put and 11,700 call. So buying both 11,400 put and 11,700 call is buying that strangle. And going short in both 11,400 put and 11,700 call, going short in both is shorting the strangle.
Okay, so for our viewers, just for the benefit, there are two option strategies that Abhijit just highlighted for you. One is straddle, one is strangle. The basic difference is in straddle, the two strikes are actually the same. So if you're talking about 11,500 straddle or Nifty, it'll be 11,500 call as well as 11,500 put. Whereas in strangle, your strike prices are different. So it could be 11,300 put or 11,500 call. So will it be right to say if I'm using a strangle, I'm trading for a range here?
If you are shorting a strangle, you are trading a range. If you are buying a strangle, that is usually done, especially near an event, maybe something like a budget or a big event, where there is going to be a big volatility, which is something which people expect. Only in those cases, buying a strangle might work. Again, I'm not saying it will work. It might work, but typically strangles are shorted.
Okay,
Because,
typically
I mean,
strangles are shorted, you're
yes.
saying. Okay, so that's the sum and substance of what straddle and strangle is, but that's not the end. There are a lot of charts coming up with Abhijit loves to talk. But before I get there, Abhijit, I know you plot these straddles, strangles on different charts. What all do you need for for plotting this? You need real-time data. What sort of software do you use?
Any charting software can plot these charts. I mean, these are just anywhere. I mean, you just need a price point. So that software should be able to make a total of the call and the put at that particular time and plot it as a total.
Okay.
So when you plot a straddle, it is plotted as a total of the call and the put at that point of time.
And at Definet Solutions, what software are you guys
we use
using?
Trade Point software, which is our own proprietary software. And
That's your proprietary software?
Proprietary software, yeah.
Okay, so are you, can others use that?
Yes, we sell that software also.
And are these software, you can customize the sort of trade
Yes,
that
they can be customized, and one good thing is we have developed this over the last couple of years to make it the ease of plotting these charts is very fast. I mean, within a couple of minutes, you can plot whatever straddle or strangle you want. I have also used another software called Ami Broker in the past, where it used to take more time to plot these straddles and strangles, and that's why I find this better than...
So to execute these strategies, you need a software because you need real-time data.
Yeah, charting software is needed, real-time data is needed. That also we provide. We are authorized vendors.
And you can customize according to how you want to execute a trade.
Yes.
All right, let's get to the next part then. Little bit of theory, but I'm just going to cover more theory with regard to three types of charts, which Abhijit is going to discuss with us. On these three charts, he plots straddles as well as strangles, which is line chart, candlestick chart, which all of us have heard about, and also PNF chart, which is the price and figure chart. So Abhijit, let's start off with line. I know this is the simplest which people talk about. We've been learning this. You just plot the closing prices of any stock, index, or anything under the sun, and you get a trend basically.
Yeah.
So
what happens is you need to define a time frame to plot a line chart. So either it is a 5-minute chart or a 15-minute chart or a hourly chart or a daily chart, and the closing price of that time frame. So if it's a 5-minute, the closing price every 5th minute. So 0 to 5, 5 to 10, 10 to 15, the closing price of that price band is plotted as a point, and those points are joined, and that forms a line chart.
So that's interesting. You're only using closing prices. By defining your time frame, it could be daily, it could be weekly, it could also be 5 minutes, 10 minutes, 15 minutes. So that's a line chart for you. Okay. Moving, let's just pull up a chart actually of Nifty last 1 month. That's going to give you a good sense of how a line chart actually looks like, Abhijit. So we've tried giving this 1 month line chart. This is giving you, I guess, the closing prices of every day?
Yeah, these are the closing prices of every day. So depending on, of course, the dates are not visible, but you can see from July and I think the whole of August till today. every single point, rather this is 1 point, this is 1 point. So this is the closing of that
prices
day.
of every
Specific
single
day.
trading day, and hence it gives you a trend in the form of a line that we're seeing.
Yes.
So anything that you infer from just 1 month's chart of Nifty here?
Yeah, here one can very clearly say there's an uptrend which is going on. It's always a higher top, higher bottom formation.
Right.
And only when the price starts going sideways, then there's a problem, because a small dip, and then if it goes below this and it can go again higher, that is when the confusion starts, and that is when the noise comes into the mind of the...
So Abhijit, this is the lowest, I guess, of last 1 month. What happens if the index falls before, below this level?
Yeah, actually right now this will be the
that's the near-term low. Okay, that's the first support you look at.
Yeah, but if it goes below that, then the market will become weak.
That it will become weak.
Yeah.
Okay, so that's about a line chart. We took an example of Nifty last 1 month closing prices, and the trend actually is looking high. We know that because the markets are almost at record high levels. That's about line. Let's move on to candlestick chart and try to understand how is candlestick different from a line chart, Abhijit?
Yeah, in candlestick, what happens is, again here you have to define the time frame.
Okay.
Whether it is daily, every candlestick is a time frame.
So that's your flexibility. You can take any time frame for plotting any sort of chart.
Gives you the flexibility to change the time frame. It can be daily, weekly, monthly, or if it is intraday, it can be hourly, 15 minutes, 30 minutes, 5 minutes, or even 1 minute. So every candle, there are 4 price points. One is the open, one is the close, one is the highest, and one is the lowest of that price band.
Okay.
So if you're talking about a 5-minute candle, in those 5 minutes, what is the high, what is the low, what is the open, and what is the close?
Okay.
If it is a daily candle, high of the day, low of the day.
Okay, so basically let's look at this candle then, Abhijit.
Yeah.
It's giving me an open price here, close price there. That's obviously the high of the day, and the low price. So every time it's going to be plotted like this?
Yeah, candlestick is always plotted like that, where if the close is above the open, that means it was a bullish day. If the close is below the open, it was a bearish day. So in terms of color of the candle, that will change.
So when you're looking, over a period of time, whatever time period you select, be it 5 minutes or 10 minutes, or it could be a daily chart, the most important thing would be whether the closing happened above the opening or below the opening?
Yes, that is the basic criteria which people follow to identify a short-term trend, where the closing is above the opening. Yes, you are right.
So if closing is above the opening, it is giving you a bullish signal.
Yes.
And if it's below that, it's a bearish signal.
It might go sideways, or it might be starting out.
So that's the second chart, candlestick. We'll get to that, how Abhijit will be plotting straddles and strangles on that. But the third one, which is quite interesting and very complex too, and that's price and figure chart. What is point and figure? Sorry, pardon me for that. Point and figure. What is it?
Point and figure charts are basically, if you see any chart, like we saw candlestick or line chart, we had a x-axis which had the time, and a y-axis which had the price. So in point and figure chart, there is no x-axis. I mean, there is no time on the x-axis. These charts are based only on the price movement, and you can define how much price move should get amplified, should get plotted on the chart, and based on that, the columns are plotted.
Okay.
So in point and figure, the X column means the price is rising, the O column means the price is falling. It is as simple. It is not complex. It is the simplest form of chart.
No, how? But let's say if the market is range bound and you're waiting for a substantial move either on the upside or on the downside, if that doesn't take place, let's say for the next 5-6 trading session, you're saying the chart doesn't move at all?
The chart doesn't move at all. In fact, to look at these charts is the most boring thing, especially intraday charts.
And maybe you have to be patient too then if it's boring.
In candlestick, there is at least some action on the charts. They move, even the line chart move, but sometimes the point and figure chart just don't move at all. So they can be a bit boring also.
So how do you define the quantum of that increase or decrease while plotting those X's and O's on the chart?
That depends on your, the time frame in which you want to trade.
Okay.
If you are a short-term trader, you reduce the box size. If you are a long-term trader, you increase the box size. So it basically what is the view you want to trade with? Whether you want to trade for next 3 years or next 3 hours, that will define the box size.
So this is a point and figure chart. Abhijit, if you could explain to our viewers, how is it plotted?
Yeah, so it is the same chart which we saw earlier, the line chart and the candlestick chart. So here all the green columns are basically called column of X.
These?
Yeah, the green columns are column of X where the price is going up.
Okay.
And whenever there is a correction in the market, based on the parameters which you have defined for the box size, the red column starts, which is a column of O. So it's basically X and O. So from a distance, it is not difficult. It is not possible to exactly understand what it is. but they are nothing but
X's and
O.
O's. Okay, so just for the benefit of our viewers, this green is basically X's being plotted on the chart whenever there was a substantial increase on any of the stock or index.
One small thing, every X is the box size which you have defined.
Okay.
Whether it is 0.5% or 10 points or...
So you define the quantum of increase.
Yeah.
So every X is, let's say if I've defined it as 1%, every X is 1%.
Right. Yeah.
And even on the
then
downside?
In a point and figure chart, it is 1% by 3. So after it falls by more than 3%, then the O will start getting plotted.
Okay, so is that a threshold 3% or you define it yourself?
That is what is generally used everywhere.
Okay, so it's a conventional way of using it. Abhijit, okay, to me it still looks quite complex. I'm sure to our viewers too. Give me, on this chart, is there any fresh breakout or something where somebody can look to take a trade?
Yeah, so the simplest form of interpreting these charts is whenever there is once this top is crossed in the next column, this is called a double top buy.
Okay.
In a conventional jargon, double top is a bearish thing, but in point and figure, double top is actually bullish.
Okay.
So double top, once this top is crossed here, this is a buy signal and the stop loss is below this.
So even this would be a buy signal in that case?
This is a buy, and this is a continuation buy.
This has crossed this, hence it's a buy.
Right.
And this has also crossed this, hence, so you can continue with your long position.
So basically it's a continuation signal.
And so there is no bearish signal on this chart?
So here, if you have a short-term view, here there was a bearish signal because this was, this came below this, so it's a double bottom sell.
Okay.
For a short-term view, but for a slightly higher time frame view, so this can be
this one.
Here you can talk about higher tops and higher bottoms.
Okay, let's just say if it's a positional trade, then I don't need to look at the short term, right? I can look at the lows,
the previous lows.
Yeah.
So that can be the stop loss and just keep riding till it comes below the previous swing low.
Okay, so basically you just told us a double top buy here. So I think we've got an example of that one.
Yeah, these are the specific examples of what a double top buy means. So this is a big column where the price moved very fast and in terms of percentage also. So if someone wants to buy here, that will be difficult because the stop loss is way below. So he has to wait for the continuation signal here.
Okay.
And here the stop loss will be very less.
Okay, yeah, because this is quite close.
Yeah.
So where do you execute your trade?
So if one is attentive here, this was the first buy, but once the price starts moving like this, then here it will be very difficult to buy because the stop loss is way below and that's a risky trade. So you have to wait for the next, this is what is called, it is a follow through buy.
Okay.
So there is a small dip.
But how do you decide you book your profits when the price is
here you have to
so
just
much?
keep trailing.
You just need to go on trailing? Okay.
Or maybe some predefined target. Again, in our software, we have predefined, the software can plot targets also. So there you can book partially.
Okay, so that's point and figure chart. And trust me, there are a lot of charts coming up on the show, especially with regard to that. So let's just try to first sum up line, candlestick, and the third one, which we just discussed, PNF. Abhijit, which one do you use the most?
I use point and figure most because of the biggest reason I have started using point and figure is they are extremely objective in nature.
So when you say objective, there is the takeaway will be the same. If I look at the chart, my takeaway, your takeaway would be the same on a PNF chart.
I can just give an example. If one has a bearish view on Nifty and the other person has a bullish view on Nifty, the same candlestick chart or the line chart, they can still have their own views and say that Nifty will come down. But in a point and figure chart, there can be only one view. If it's a continuation column which is going on, there is nothing bearish in it unless it starts coming down. So that's why I'm saying objective. So as long as this X continues, it is bullish.
So line and candlestick are subjective in nature. PNF is objective, right? And
right.
between line and candlestick, which one would you use the most?
Candlestick is used more than line.
Okay.
But in terms of comparing the three, for point and figure, the nearest comparison can be with the line chart because they are more like point and figure than candlestick charts.
Okay, so we've spent time on discussing what is a straddle, what is a strangle, these two option strategies with Abhijit Phatak employees only, mind you, only using prices and not using option Greeks. And then the three charts on which he plots these straddles and strangles, which is line chart, candlestick, as well as point and figure. Let's move on then. How do you plot these strategies? I want to first start off on a candlestick chart. How do you plot a straddle or a strangle? So
basically what happens is, like I said, at every point of time, the software adds the premium of the call and the premium of the put and plots it. So this is a candlestick chart of a straddle. I'm not sure which one. It is just an example. So let's say 11,300.
Sure, anything. It can be a stock, it can be an index.
Every single, again, the time frame has to be defined. Let's say this is a 15-minute chart. So every candle is of 15 minutes.
Okay.
So what
that function, Abhijit, I'm really sorry to interrupt. That function is there in the software to define a time frame?
Yes, every software has the time. I mean, you can change the time frame to whatever you want. I mean,
and while you know, I'm trying to observe something, making a trend, can I in between change the time frame, or it has to be same throughout the trade?
No, you can change as many times as you want. Yeah.
Okay, go ahead. Sorry.
So what happens is every 15 minutes a candlestick is plotted, which is basically it has again those 4 points: open, high, low, close. And every single point is the addition of the call and addition of the put premium.
Okay.
So those are plotted as a chart.
Okay. So hypothetically, let's say if it's a straddle on Nifty, take any particular strike.
So let's say right now the last price is something like, let's say 280.
Okay.
So what 280 means is out of which maybe 150 is the call and 130 is the put.
Okay, so
that is how it is 280.
You've combined, Abhijit, both the premium of 11. I'm just taking any hypothetical strike, 11,500, let's say, a premium of 130 or whatever. The total premium right now is 260 or 270. That gets plotted. Now the movement of candlestick that we are seeing, it is of the combined premium of both the strikes, right?
Right.
So what do I infer from this chart?
So as I said, there is in candlestick chart, okay, here you can identify there is a downtrend. Again, there is a downtrend, but then where to take a trade, that is a bit subjective. That is why I talked about being subjective. Whereas in point and figure, it is exactly you can pinpoint where to take a trade.
Where to take a trade.
You can identify it is coming down, and then it is going sideways, then again it is coming down.
Okay, so the red candles are when the price.
Yeah, red means coming down, green means going up. Yeah.
Okay, so here it's you're saying it's difficult to identify when to take a trade.
Yeah.
Okay, so that's a straddle on a candlestick, but let's move on and now discuss a straddle on a line chart, how that one looks like. Let's just pull up that chart and see how to plot a straddle strategy on a line chart, which will just come up on your screen. But Abhijit, you said these are, you know, subjective in nature. This is a straddle on a line chart. How would you define this one?
Yeah, here again, every single point is the closing price of the time frame which you have selected. So let's say you have selected an hour. So this will plot a point after 1 hour is complete. So maybe 9:15 will be the first point, 10:15 will be the next point, 11:15 a.m. will be the third. And in between, whatever has happened does not get plotted. Maybe the price has gone up, gone down, and come back here. So that kind of volatility in between is not seen on the line.
Because this is very easy to infer. The premiums are falling.
Yeah, it is. Like I said, interpretation is easy. This is coming down. But then if someone wants to trade it, then entry point, I mean, identifying an entry is difficult here.
Identifying
and again, the problem is like within that 1 hour. This is only the closing of that 1 hour.
So do people really use line charts for, you know, strategies like
these? To be honest, I think very few people use line charts. Majority use candlestick charts or bar charts.
It's very difficult to identify, and I think it's just giving me a trend, Abhijit, that the premium is falling.
Yeah.
Right? At least in candlestick, you may still try and, you know, identify a level where maybe a trade could be executed or not. But the third one, let's pull up the PNF chart where Abhijit has tried plotting a straddle, and according to him, he uses this chart the most as it is an objective one. So Abhijit, it's all yours. There's too many. There are too many things in the screen.
Here it is the green columns are X, column X, where the price is going up, rising.
So those are X's.
The O column, which is shown in red, is where the price is falling. Then we have a tool, a couple of indicators called the moving average, which is the line, the 3 lines which you are seeing.
So these 3 lines you're suggesting, these are the moving averages.
Moving averages.
Okay.
And this is a proprietary indicator inbuilt into the software, which is called the XO zone.
Okay.
So that is really indicative of the trend.
Okay.
Here again, if you can see, there is a double bottom cell here.
Okay, just for the benefit of our viewers, Abhijit, this is an 11,300 straddle example that you're trying to give here on a PNF
This was
chart.
taken 3 days back, so
that's
it's not
fine. Viewers, these rates were taken actually 3 days back, so that's just about fine. But we're just trying to understand how Abhijit has been trying to plot the premium on a PNF chart of 11,300 straddle. Now remember, just to revisit, a straddle is 11,300 call and the 11,300 put. So what Abhijit has done, he's combined the premium of both and plotted it here. Right, Abhijit?
Yeah.
Okay, go ahead.
So what happens is, if you apply the basic theories of point and figure, once it is below the moving average and it has given a double bottom cell, if someone really wants to trade this straddle, this is a very good point to go short.
So you're saying this is the double bottom
Yeah, so
sell.
this bottom and this bottom broken, this red line is the trigger for the double bottom sell.
Okay.
And here the stop loss is extremely close and extremely well defined. That
Okay.
is what I mean by objective.
Okay, tell me one thing. These are O's and these are X's, is it?
Yeah, the green one is there are small X's, so
Okay.
from a distance you can't identify what it is.
Here the premium has been plotted only when there was a substantial rise or a substantial fall, right?
These charts are 0.25% by 3. So what it means is whenever the price of the combined premium moves by more than 0.25%, one more X is plotted.
Okay.
So every X is 0.25%. So let's say this is around 300. So 0.25% of 300 is the range of the move which is necessary for plotting another X or
Okay.
O.
That's according to your how you
so that
set
0.25% can be changed as per the user's.
And what's the success ratio of this as compared to candlestick and line?
Actually, it all boils down to discipline. So, you know, any trade, this is just another way of looking at the market. This is not the holy grail. So, this is not something
So
which...
this is just your way of trading.
Yeah.
That's totally fine. There are
So
a lot
as long
of
as you
traders.
follow every signal in terms
Okay.
of the interpretation, as long as you don't think of going long here, this is
So,
not a place to go long.
Okay,
so this is
the place to go short.
yeah, this when it crosses over from green to red, that is where it one can go short. That is a signal to go short,
And this
and then
is
carry it till it remains red.
okay. So that's a 11,300 nifty straddle on a PNF chart, which according to Abhijit is more objective in nature. It tells you basically at every point where the trade can be executed, whereas on a line and a candlestick it becomes a little trickier. But I think you've got whole host of charts when it comes to PNF. So let's start off with the price versus time chart that will just come up on your screen to identify how Abhijit is actually monitoring the time and the prices both at one go in order to execute a trade. So Abhijit, all yours.
Yeah, so these are conventional charts where, like I said, the x-axis is the time, y-axis is the price. So based on your time frame, so let's say this is your time frame is 1 hour. So every candle is 1 hour. So if that is 9:15 to 10:15, this is 10:15 to 11:15, this is 11:15 to 12:15
Okay.
in a day. So and then the when it is rising, it is green. When it is falling, it is red. Yeah.
No, so we're calling this conventional.
Conventional. This is
versus-
candlestick. Yeah.
This is a candlestick.
This is a candlestick chart. So
Okay.
what it means is it has two parameters. One is price. The other is time.
So here prices are up, here they're going down. Is it the right way of looking at it?
Yeah, here actually it's just an example. There is no trend here. This was only to highlight that even time is involved in a candlestick chart.
Okay. Okay, so let's just pull up the other chart then. This is just an example of how PNF is different than a conventional candlestick chart that we've been plotting. But other than that, this is the conventional.
So what happens in PNF is these are the square boxes which we talk about. Either it's an X or an O. So if it is going
Okay.
up by that much of an extent, the software plots an X.
I'm going to be plotting X's here
Yeah,
because the
every
price
box is
going
an
up.
X and
Okay.
it goes up. And then based on the reversal value, which is 3 box, then the O, if the price starts coming down, you plot a O. So, and then every, let's say it is 0.5%. So every 0.5% moving down, you add another O.
Okay, but I've put, let's say these are all X's, this is all O's from here to here.
Yeah, so the point is there is nothing of time involved in this.
Okay.
This move can be over
price.
2 hours. This move can be over 2 weeks.
Okay. So you need to be really patient. It's not that on every
Yeah,
daily
it all
basis.
boils down to what box size you need to decide and what time frame you want to trade on.
Okay. So basically X's and O's tells you whether there's a substantial increase in prices or decrease in prices, and that's the only time you plot them on the chart. I think meanwhile, let's just keep pulling up the charts so that Abhijit can take us through that in the PNF. And this is
So
the
just to
next
give
one.
an example, if this is, let's say any stock or any index, if the price moves from 109, 10, 11, 12, 13, every time based on the box size, the one more additional X will be added. And if the price goes down, in fact, this is the oldest way of plotting a point and figure chart. The point and figure charts which we see now, earlier they used to actually write these numbers on a chart.
You're
on a
saying
graph
this is an
paper.
old way. Earlier there were no X's and O's, you just used to write the price.
Yeah, and then they realized that instead of putting the price, they took the price as the index on the x-axis, y-axis, and then they started plotting only x's.
Okay, let's just pull up the next chart now. We've got the point.
So this is another example of price going from 1000 to 1045, and the box size is 5, because you can see 1000. The next one is 1005.
5.
The next third one is 1010, which means the box size is 5 points.
Okay.
So on every 5-point increase, 1 X is added on the...
Got it. So you've defined that with every 5 rupee or every 5-point increase, you're going to be plotting your X's, and that goes for the O's as well, right?
Yeah, so and if it is a 1-box reversal, that means if the, let's say from 1040, it goes to 1035 and then 1030, then the O's will get plotted.
Okay.
Only when the price starts coming down.
So from 1000, you're saying from 1035, it started to come down, and
yeah, then that's why this is a 1-box reversal. So this is 5 points is the box size and 1 box. So once the decline is more than 1 box, the first O is plotted.
I know this is just an example.
Yeah, this is just an example.
Yeah, anything you could tell me from these levels, where would you execute a trade?
Now here, I'll just, if you take the next slide, that this is the same chart on a line. The next slide.
Okay, let's
here.
just pull up the next.
Not this one.
Okay, this is the point in. These are all under point and figure.
The same prices if plotted on a line chart. Now what happens is here one can easily define it's an uptrend, but once it starts coming down, that is where the subjectivity comes and interpretation comes. So one is not sure whether that is the top and a downtrend has started, or it's just a pullback or a correction. And then you have to wait till that next top is crossed, and then again. So what we call is this is noise on the chart. Whereas on a point and figure chart, if you can go back to the previous chart.
So you're saying PNF filters out all the noise that's there in the market.
So here, once this column is, this is a reversal column. So once this, so there is no way one can go long when this column is in progress.
Sure.
So one has to go long only above this, which will be a double top buy.
Okay, so let's just pull up the other slide, which we have to explain with regard to what about this?
Yeah, so this is just an example of what I said. So every time there is a pullback, I think this is same example. So earlier there was a column of X's, then a small pullback in which there was 3 O's.
Okay.
Then another continuation. Yeah, those are 3 O's.
Yeah.
So another continuation.
And then from here it's going up. So these are all.
One can go long on a break above this.
Break above this, you're saying.
Okay. And with this as the lowest point of this as a stop loss.
Okay, so when you're going long here, remember your stop loss has to be the low.
Yeah, so it is a well-defined stop loss which you know even before taking the trade.
Okay.
That's why I use the word objective.
Okay, so here the high price is 110, Abhijit, and the lowest is about 95, right?
Yeah, so what I want, this is an example over here. Now this was from 5th April to 15th April. This is an actual example of a stock. I don't know which stock it is.
Okay.
But the price moved from 95 to 110, which is more than 15% move, and in 10 days. But here it appears in only one column.
Okay.
So there is no noise on the chart.
All right. I think we've already discussed double top buy and double top sell. We've not double bottom sell, but let's just revisit them.
This is another example of how it filters out noise. This is actually Nifty, which we had on the as an example. This is from 11th April 2016 to 18th April 2016.
Okay.
A period of 1 week in which Nifty had gone up by I think 600 or 700 points, which was 7 or 8%.
Yeah.
So because there was no pullback at all, it was just one single column.
So you're saying there were no O's plotted at that point of time?
At all.
So total uptrend.
So that's why it is boring. So in this period, if you're long, you don't have to do anything.
Okay, but I have a question here. You have to somewhere, Abhijit, book out your position, because not every trader is a positional trader. They do have a time frame in mind, and if the market, like in the previous example, was just about going up, how do you decide then when to book out?
There are 2 ways of booking. One is either have a predetermined target, mental target in terms of maybe rupee value.
You know how traders' psyche is, you wait for more every time.
Yeah, but then I mean here it's a game of patience in any case.
Okay.
Or on Trade Point software, we have what is called a vertical count.
Okay.
It plots the counts based on arithmetic calculations, and it gives potential targets.
Okay.
So
you're saying the software is giving potential targets.
You can plot targets.
So accordingly, one can take a call when to book out or something. All right, Abhijit, this is a double top buy signal.
Yeah, this is again repeating the same double top buy. So how, if there's a big move, there is a problem where to enter, so you wait for the next follow through buy. So this is just a amplified example of a double top buy.
And let's just pull up the double bottom sell signal now that one can see on the chart.
So this is something which is a bearish trade. So here there was an up move earlier, then the price started reversing, then there was a double bottom sell on when that O was broken, and then the downtrend started.
Okay,
and then this was the first double bottom sell. This was a continuation double bottom sell.
Here?
Yeah, that was the first. In this column, when it broke this low, trigger happened.
So this is the first, this is the second, this is the third, am I right?
Yeah, so it's a downtrend all the way from there to here.
Okay, so that's a double bottom sell on a PNF chart. Is there anything else under PNF that we need to discuss? Yes.
No, in fact, there is another signal called a triple top buy, which is even more bullish than a double top. So, just to explain how it looks on a line chart, this is how it will look on a line chart, where it makes a top, comes down, again makes a top somewhere, again comes down. This is where there is a lot of confusion. People think that it's a double top, so it's going to be a bearish.
That's a breakout, but it becomes very difficult.
And this breakout is a triple top buy.
Oh, so on a PNF chart, you get it here.
Yeah. So this breakout is how it looks on a point and figure chart.
No, Abhijit, I have a question here. So here, if I'm saying this is the breakout, you're saying?
Yeah.
So what about here?
No, here this was, since it would have been a double top buy if it had crossed this X.
Okay. So
that didn't happen.
Then it's here, right? Because it's crossed this level.
Yeah, this is a breakout.
Okay.
Which is called a triple top buy. So it has crossed these two tops and a third top.
So when this crosses these two tops, I get to know I have to take a position on the upside.
Yeah.
Whereas it becomes little difficult on the line chart, isn't it? Because this and this is just about the same, and that's a fresh breakout, which you may not be able to identify.
Right. So that's what I mean about subjective.
So
and
maybe
objective.
you don't get to know the timing on the line chart when exactly.
That is also
right?
there. Yeah. So here it only depends on once, and here you know even when this O is being formed, when price is in this range, you know very clearly once this breaks out above this, you have to go long. And then this will be the stop loss. So your entry as well as exit.
This is the stop loss.
Yeah. Okay. Is known even before you take the trade.
Okay. And in that, even if I take a trade, how do I decide my stop loss?
Yeah, the stop loss will be here, fine. But then, first of all, because of this downtrend, here the mind will start playing games and people will start thinking it will again go back and then come down again.
Okay, some people say trading is all about mind games, but we've discussed, I guess, in detail PNF chart, which Abhijit wanted to talk at length. Reason being, he uses them the most as opposed to something like line or candlestick. I think you still do use candlesticks sometimes,
yes,
right?
Yeah, I use them, yeah.
Okay, so let's move on to our next segment where we would be plotting straddles and strangles for indices. So let's just pull up the Nifty 11,400 straddle with that example. Abhijit, if you can take this forward.
Yeah, so this is a straddle of 11,400 strike price. So on the
just
top,
to again remind our viewers, this is 11,400 call, 11,400 put of Nifty. We've combined the premiums and that's been plotted on the chart.
Yeah, so what I have shown here is this is the top side, the top part of the chart is the straddle chart. The bottom part is the individual call and the individual put, which together is the top chart.
Correct.
So here the call has moved up. I mean, this is the call, this is the put. So the call has moved up, the put has moved down, but in spite of the call moving up, the straddle has moved down all the way.
Okay.
So what it means is, the way I interpret it is, the momentum in the call was not enough to negate the downside momentum in the put, to take the straddle up. And this is a sign that the market was sideways that time.
Okay, but this is before you take a position, you look at this chart whether a position can be taken.
Yes.
Now, if this is showing me a downtrend, you wouldn't take a position.
One can take a long position only in the call, but
not a strategy of straddle.
Not for the straddle. In fact, what one typically can do is buy a 11,300 call and go short in this straddle.
Okay. So that's the next step, but basically just looking at this chart is what we, the takeaway that the 11,400 straddle premium has been falling. So hence, according to Abhijit, there's no position that can be taken with regard to 11,400. But remember, if you're looking at some differently 11,400 call as well as put, according to Abhijit, you can buy the call, right?
Yeah, buying the call is fine, but see what happens is this straddle helps in identifying whether there is momentum in the market. If this breaks out and goes up, that means there is big momentum in the market, and this straddle, the momentum in the call will negate completely the downtrend, because when let's say Nifty is going up, put will go down.
Correct.
And the call will go up. But if the momentum is really strong, the rise in the call premium will negate the fall in the put premium.
Agreed.
And take the straddle up.
So simultaneously you cannot buy both. Because
there
it's
is no need to buy both,
the
you can just buy the call, yeah.
Okay, so that's about the 11,400 straddle on Nifty. Let's just pull up Bank Nifty. That's too much in demand because of the weekly options expiry, Abhijit, which we had one of them today.
Yeah, this is Bank Nifty monthly 28,000 straddle. Okay. Everyone was very bullish on Bank Nifty over the last few days, and the charts were bullish, no doubt. and we had targets of 28,700, 29,000, 30,000 this expiry, you know. But 28,000 straddle was steadily coming down all the way from last almost a week, and the premium which was 1,000 initially, I think today it is less than 500 because the expiry was near 28,100. Yes. And the more it falls down, that means lower chances of Bank Nifty making a big move.
In fact, we've seen Nifty touching fresh highs, you know, every day, but not Bank Nifty. We're yet to touch that all-time high of 28,377 or 378. So you're saying avoid, you cannot, looking at this chart, you cannot take a trade on the 28,000 straddle.
On the straddle, the only trade on the straddle is going short.
28,000 put?
One can go short on the 28,000 put as well because the call is going up, but the momentum is not so strong for the single call to take the straddle up. So either go short in the straddle or go short in the put.
Okay.
So what it means is the put is in a downtrend. So Bank Nifty is bullish, no doubt, because the put is in a downtrend.
Because we're still around the all-time high levels.
Bullish, it is range bound with a bullish buy.
It's just a near-term consolidation that you're seeing on Bank Nifty, and also that overhang is always there of the weekly options expiry day.
In fact, because of weekly options, the monthly straddles are more prone to going drifting down.
Okay, that's Nifty and Bank Nifty example for you all. There are a lot of charts right now. Let's just pull up the next one. This is Nifty Strangle. Okay, we've moved from straddle to strangle, by the way, viewers. 11,500 call and the 11,300 put. Remember, in a strangle, we use different strike prices, but of the same expiry. Abhijit, take it away.
Yeah, what happens is, in this case, every single point is the addition of the 11,300 put and 11,500 call.
Okay, so here also we've combined the premium.
Yeah, the put and call premium is combined and then plotted.
Okay.
And this helps in identifying the range for that expiry.
Okay.
Let's say, I don't have an idea when this was the starting point, but let's say this, I think this was from the starting of August expiry.
Fair enough.
It was very clear that the fact that this strangle is coming down, that means we are not going to see a very major breakout above 11,500, 600 or below 11,300. So as long as this premium is coming down, that means this range is, breaking out to new highs, maybe 11,700 looks unlikely as of now.
Okay, I have a question because I think we've already crossed the 11,600 mark on Nifty. But if I were to look at the markets, Abhijit, in the last 3 sessions, it's been more of a consolidation and a profit booking phase. So I'm just presuming here, maybe the straddle on 11,600 and the 11,500 could be heading lower, not drastically.
They are heading lower, and that indicates that one should be cautious with longs at this level.
Okay.
Unless in fact, I had also talked about a level of 200 on the 11,400 straddle. That is not getting broken. Nifty's
so what do you do in a scenario like this? Markets are still at record high levels. We know there is some bit of profit booking. We know that the expiry is coming up. So how do you execute a trade in an environment or a situation like this?
There are 2 ways to trade this kind of market. Either go short in the higher straddle like 11,500 or 600. But if someone is not really, it can be a bit risky for some, and they don't have that much confidence. But then you can, what you can do is you can identify supports and resistances maybe on an intraday basis on the underlying, which is Nifty in this case. And since the straddle is going down, it is not going to fall drastically. So identify a support and go long at that support with a good stop loss. Okay, identify resistance, go short at the resistance. Again, so that is how you play that range.
Very basic question. How do you identify in the first place whether it should be a straddle or
These are basic, anyone who uses moving averages or VWAP or previous day's low. So whenever it comes near the previous day's low, since the straddle is still going down, that means it is not going to crash very much. So use that as a stop loss and go long.
Okay, all right. Okay, so we've discussed on the index how to use strategies like straddle and strangle only by looking at the price action. And in this case, price action is actually your premiums that are being quoted on different strikes. So let's move on and take some examples of stocks as well, how to deploy, strategies like straddle, strangle on a stock. So we've got the first one on Maruti, and that's a 8,700 put and a 9,000 call. That's
this is something which happened in July. Okay. That time, before that, Maruti had gone up from 8,300 to 87, 8,800 and was consolidating, and it was over the next 3-4 days it did nothing. It went to 89, came back to 87, and again it was in the 200 point range. And then suddenly one day I realized 87,000 put and 9,000 call. Now, why I selected these two strike prices?
So this is for the July series.
This is for the July
okay,
series, yeah.
Okay, all right.
The reason I selected these two strike prices was 8700 put was the highest open interest.
Okay.
And 9,000 call was the highest open interest.
Okay, is that the basic?
Yeah, that is one of the criteria which I use. It cannot be used for index.
Because when we look at the derivatives data for Nifty, I usually look at the maximum open interest for on the call and the put side for Nifty as well, just to give me a range for that particular.
Yeah, so this cannot be used for index because the range of the highest open interest is quite large, and index doesn't give that kind of a move. But stocks can give a move of 5-10% over a period of maybe just a couple of days.
Hence, you deploy mostly a strangle.
Yeah,
in
that
stocks?
is the reason I use strangle for stocks, where if the highest open interest strike prices are almost, I mean, not close, but not near, but maybe within 5%. Like this was, I mean, just 300 points, so it was not even 4%.
So stock can move 5 to 7% in 2-3 days.
Yeah, and what happened
time,
was once this strangle is plotted, I think it was, I remember very clearly, this was making a base near 200, 210. If you see the bottom. And then suddenly it shot up.
Yes, here.
Yeah.
This
that
is
yeah.
Okay. I think we've got one more chart with regard to Maruti.
Yeah, in that I have explained how the same chart, which is the lower part of the chart, the upper part of the chart is the 9,000 call and the 8,700 put. So this is the 9,000 call.
So
this
here,
is the
Abhijit, you plotting call premium and put premium separately, right?
Yeah,
so
these are separate individual charts of the call and the put.
And the red one is put.
Yeah. Okay. So what happened was the put started going down, the call started going up, and it is at this level that the strangle started going up. And the reason this strangle started going up because the momentum in the 9,000 call
was higher.
Was so high that it negated the momentum in the downtrend of the put.
Okay, that brings me to one of the Greeks we used, IVs. So is that something got to do with it, or are you totally avoiding
No, I
it?
don't look at IVs at all. As long as the chart, the price says it is going up, it is going up. So trade with the stop loss and.
So here you're saying the momentum or the magnitude of increase on the call premium is higher than the put premium.
And if it is continuously making higher tops, so here we have that bottom pane, which is the exo zone. If every few half an hour, 1 hour, the previous top is crossed, that means it is in an uptrend. So use some stop loss and be long.
Okay, and where exactly you go long here?
This is the place where one can go long. Now here there is no need to go in a strangle, go long in a strangle, because there is no point in buying a put.
When you say here, this is the time when the call premium is
Yes, exactly. So once you identify the strangle giving a buy signal and the call going up, that is when one can buy the call.
Okay, so that strangle example on a couple of the stocks, I think we can just try and see how a straddle also works on different stocks. So let's just pull up TCS August 2000 straddle chart and check with Abhijit how.
Yeah, this is the classic example of TCS where there was a buyback date which went a few days back, and a lot of people were bullish on TCS.
21st August.
Yeah, recently.
Sorry.
But at the same time, the 2000 straddle almost for the last 10 days was coming down all the way from 72 to I think it has gone today below 50. If I don't, okay. This is a chart which is 2 days old. But the straddle indicated the straddle chart of 2000 because TCS also was near 2000.
Correct.
The underlying price.
950 to 2000 it was trading. It did touch that level.
2020. I think today it was 2030.
Touch that level in the
but the straddle chart indicated there is no momentum on either side. That's
why the reason of that could also be because the buyback date
I don't know the reason.
Closer.
My only logic was this stock is not going to move as long as this straddle is coming down.
So when the buyback was announced, I remember the stocks moved 100 rupees or maybe little more than that between 1900 to 2000. Yeah. The top would have been somewhere about 2025. Now buyback price is 2100. So would that also mean at least till that buyback is completed, the price may not cross that level?
I have no idea how the buyback works and how, I mean, for different stock it is different again.
Yeah, because of the news, I guess this movement was seen.
Yeah. This only tells me that there is no momentum in the TCS stock, the underlying, there is no momentum, so better to go short in the straddle.
Okay. Better to go in a 2000 straddle of TCS, and this is for the August series. Just one more chart, viewers. Axis Bank 630 straddle, which Abhijit has for us. Abhijit, what about this one? Because recently we did see a lot of traction.
Yeah, in fact, Axis Bank has gone up all the way from 580 to 640.
Yeah.
And everyone is looking at a breakout of 635, 640, which it is trying to do. But again, this chart was a couple of days back, and this is a 630 straddle, which was, I think, plotted till 3 days back. I mean, just before the holiday. And this straddle indicates that unless this is crossed, Axis Bank might not cross 645, 645, which is the long-term resistance on Axis Bank. So this is a place where one should be cautious if you are long in Axis Bank.
Okay, and does expiry has any role to play in it when to execute the strategy? If you're like start of the new series?
Yeah, because see, the ideal time is when there is the number of days to expiry is quite high. I mean, the first week of expiry, because there is a lot of time value in the options. If it is closer to the expiry, the time value is
time decay and you get the premiums contract
exactly.
to
So premium is
to
high.
Expiry.
There is no point in going short in a straddle just few days, because then the gamma effect comes into play, which is a bit of Greeks. I typically don't use Greeks, but because of this, what happens is if there is a big move in the stock, this straddle will give a big move, and so then it becomes risky to go short in now is not the time to go short in a straddle or a strangle.
Okay, so this chart also basically tells you not to execute the 630 straddle, is it?
Sorry?
Does this chart tells you not to execute a 630 straddle?
Yeah, now it is too late, and again, as I said, expiry is only 4 days away, so now it is too late. But then this straddle, even when Axis Bank was well above 600, near 620, 625, it was range bound for the last few days. This straddle was continuously going down. Even today, I think this has come below.
Okay.
This was a spike which happened only on day before yesterday.
Yes.
After that, it has again come down.
Okay, so that's Axis Bank 630 straddle. Guys, we've discussed a lot of charts. I've never in my life seen so many charts one after the other. But Abhijit, you've got a lot of followers and we've started getting some queries. So let's just start, addressing some of the queries. This one comes on Twitter from DN Shukla 18. That's the Twitter handle. Mr. Shukla wants to know how reliable are PNF charts. And Abhijit, have you back tested them is something he wants to know.
Yeah, in terms of reliability, like I said, they are the most objective charts in terms of where to enter and where to exit. So they are very reliable. At the same time, the entry and the exit is only on the chart. What the trader actually does is also based on his discipline and his, maybe her view. Sometimes the chart might tell something, but he might not do it.
So what's the thumb rule, Abhijit? Because you said you have to stick to that, if there is a breakout in PNF, you simply go and execute a trade. So what's the thumb rule for PNF when to execute
Like I gave the examples of double top buy or a double bottom sell.
Yeah, okay.
That's all you need.
Okay, let's move on to some more queries which this Abhijit had received. Ashwin Krishna on Twitter, he wanted to know any specific reason. I think we've discussed this during the show, why you use straddle on index and strangle on stocks.
Yeah, I'll repeat it. Why I use straddles on index and strangles on stocks is, like I said, in index, a strangle will be maybe at least 3, 4 or maybe 500 points away, which might be as of now 4 to 5%. And it is very unlikely that an index gives a 4 to 5% move over a period of, a few days. Whereas in stocks, even if it is the strangle is even 5 or 7% between the two strike prices, stocks can give this kind of move over a couple of days.
They can give you a 10% move even in a single day.
So that's why strangles are more to be used on stocks than
on indices.
On the Nifty, strangles can be used, but then to go short.
To go short.
Like I give the example of 11,500 and 11,300. That has been continuously coming down right from the beginning of August.
But never on the long side?
Strangle, the basic meaning of strangle is to go short. Strangles are not meant to be bought.
Okay. All right. Let's move on to some more queries. I think with the Twitter handle SmartX, somebody tweeted, which is more rewarding, Abhijit? Straddle turns a buying call / selling put in a straddle that has turned bullish by buying put or selling a call in a straddle that has turned bearish. It's a little complicated, but if you would address that.
There are two things in which are dependent on this. One is how much capital a person has, because for going short in an option you need more capital. Again, the risk factor, maybe an overnight risk factor, the trader has to be used. He should have been doing it in the past. He should not do it for the first time in going short in a option. Whereas buying a call or buying a put is cheaper in terms of, let's say you're buying a call for 50 rupees, you're paying only maybe 4,000 rupees, that's all. Okay. So that's the only amount you are going to lose, even if the move goes against you. But if you have a signal from the chart and buy the call, that's the cheapest way of trading it.
Okay, is there any way to hedge? I know these are all hedge strategies, but any risk which is attached?
Let's say you have a buy on Nifty.
Okay.
Maybe from 11,300 or 11,400. So if one goes long in 11,400 and then let's say after 1 week it goes to 11,500, 550, and now here you can still see from the latest chart which I saw an hour back, 11,600 straddle is still coming down.
Yes, it is. We just discussed that.
Yeah.
It is coming down.
So that is a good way to hedge. So be long in Nifty with a stop loss naturally, and go short in the 11,000.
Because the trend is on the upside.
Yeah.
Okay. Okay, let's move on. Some more queries from Gurpreet Singh. He wants to know how to know the best time to buy a strangle in a stock so that it doesn't depreciate further.
Now again here this is completely chart based, so it is objective unless the price gives a trigger, whether it gives on day one of expiry or 2 days before expiry. That is the time to buy.
He has a follow-up question, Abhijit. He's also asking at what time of the month, should you start buying strangles? Because premiums, obviously, as we discussed, are high towards the start of the expiry, and because of time decay, you see premiums contracting towards the end.
Yeah, what happens is most of there are a lot of people who start buying strangles right on day one of the expiry, expecting a big move on either side in that expiry, which might not happen at all. So that's why using these charts is a good trigger. Unless that chart gives a buy, no point in executing the buy right on day one. You wait. Maybe you have to wait for 10 days before maybe you will get a buy signal at a much lower price. Maybe you might not get a buy signal at all. So it saves your stop loss or your money for that.
Okay, now this is my question. How do you prepare yourself for a new series? Let's say you've had some position towards the expiry. What do you do with it? And
no, in fact, even now, as of today, even before August is expired, September options are still being traded.
Yes, they are.
So I can plot September straddles even today.
Okay.
And
yeah,
I can have
because the premiums are there, so they're being traded. You can plot.
In fact, this is the right time to trade September straddles where the premiums will be both
higher.
sides will be high.
Oh, okay.
So if you get a sell signal on a September straddle, you get to sell on a higher level.
Would you then say that you don't need to wait for September series to start before executing?
No need. You can. In fact, it could have been done 1 week back also.
Okay.
Yeah.
All right. I'm going to take the next question of Vishal Saxena. He wants to know how to manage a straddle or a strangle when index picks up a trend and how to achieve the same in the stock. I think this is very relevant with the current environment because the trend, Abhijit, is on the upside, be it for Nifty or Bank Nifty.
Yeah, here again the objectivity of the charts. What people, people who don't follow charts, he used the word managing a position. That is not required when you follow the chart. When you don't follow the price action on the chart, then that is when you require to manage a position by maybe if you are short in 11,400 straddle and it is going against you. So what people do is shift to a higher strike price in terms of put, and they manage that position. But here there is an objective stop loss. So get out of that trade and look for the highest straddle, maybe 11,500, and enter that straddle.
Okay. Vishal, hope we tried answering your question there. Ronak Khaitan on Twitter with the Twitter handle called Ronak Khaitan 24 writes to us. Okay, little bit of Greek there. What should one do in a low IV environment, Abhijit? Long strangle or a straddle for indices or either stocks?
No, again, IV or theta, gamma, I have heard of this. I know what it is. But I follow only the price action because finally you are going to trade the price which is on the chart. So as long as there is a signal on the chart, maybe a buy or a sell, that is the only way to trade it.
Okay, I think this one would be pretty relevant. Mohit Gupta on Twitter. We discussed the 11,400 straddle on Nifty. He's asking for the August series. When should have one ideally entered a short trade and exit? What would be the trigger for that, for the exit? And what would have been the trailing stop loss?
If you can bring up that 11,400 straddle, I can exactly show on the straddle. There are places where it gives a sell signal, so go short at that level, and once it gives a double top buy, that green exozone becomes green, exit it.
Okay, so basically,
everything is
this the
like
one?
for
Yes.
here. In fact, this was falling all the way till here, and then this made a base near 200. And it gave a double top buy here. So if anyone is short all the way from 300, 340 levels.
From these levels?
Yeah, maybe
levels?
I think that is July end, before August expiry.
Okay.
If someone is short from there, maybe 340, 350. The exit was about 220 here.
Okay. All right, so that's about, Mohit, you asked about 11,400 straddle, but he has a very interesting question. How do you keep targets while trading short straddle? Is it as a percentage of premium or you put a trailing stop loss?
Two things. One is you can have your own personal target in terms of number of points, maybe 30 points, 10% of the value of the straddle or something like that. Other way, which is what we use on the software, is the software can plot targets for the straddles or the strangles. And that gets plotted. So let's say if something is giving a weak signal at 300 and it plots a count of maybe 250 or 220. So that is a target where you can partially exit.
Okay, one more question. It's come on WhatsApp from Ashish Mehra. He wants to know how to identify, if I'm executing a trade, what should be my support and resistance in a range-bound market based on charts. It's a very interesting question because we've seen that phases after, indices touched record high levels. There is a phase of 4 or 5 sessions of range.
Yeah, if you take today's example, I mean, Nifty came all the way down from, I think, 11,620 in the morning to 11,540 was the low, if I remember correctly. I was not watching it closely. But at that point, this was a low, which was a low, I think, a few days back as well. So that was a good support. So this is purely price action. And so using that as a stop loss, one could have gone long at the low because the range was identified as per the strangles or the straddle, and the market was not likely to crash further.
Okay, guys, we're running out of time. I'm just going to take 1 or 2 more queries. Abhijit, this one comes on Twitter from a handle name called Miracle Magic. He's asking how to identify the trend if base is formed at X. I'm presuming he's referring to the PNF charts, but what will actually confirm the trend and what time frame should one use for intraday and positional trade?
If it is point and figure, what I use, I mean, it is not intraday or positional. I just use 0.25% on the point and figure charts, and that can be used for positional also. 0.25% is the box size.
0.25. That's on both X's and O's.
Yeah. It is the box size. Whether it's a X or O, the value is 0.25%.
So, okay, just another, just a counter question. Can the size of X boxes and O boxes can be different?
No, it will
has to be the same all the time.
It can be different. I mean, it can be 0.25% for X and 0.25% for O, or 0.5% or 1%. But for the both of them, it is the same.
Okay, just last question I'm taking off Mohit Gupta. He's written a lot of queries. He's asking, do you ever buy straddles looking at your straddle chart and why? Obviously, you do buy straddles looking at your chart.
What is the question?
Do you ever buy straddles looking at your straddle chart and why?
There is no point. Like I said, there is no point. Straddles and strangles, it is better to go short. But if the straddle is going up, you identify the trade, in fact, the straddle going up doesn't mean the market is going up.
Yes.
Even if the market is going down, let's say Nifty is going down, the puts are going up, that also can take the straddle up.
True, yeah.
So then go to the individual charts and see between the two which one is going up and buy that naked call or the put.
Okay, then you would, if in the range bound session, you would go for a naked call or a put.
Yeah.
Okay, guys, hope we tried answering all your queries and hope it was a very, very informative and useful session, at least for the existing, traders who execute strategies like strangles and straddles. But this time around, Abhijit gave a different angle to it. I know we all have learned derivatives, the futures and options market, looking at the option Greeks, but he's actually using the price trend before executing these strategies and also looking at charts like candlestick and PNF, which is the most important chart according to him. Abhijit, any disclaimer that you would like to give?
Yeah, I use these charts. It's not about trading these straddles and strangles. It's also about having a view of what Nifty is going to do. And I mean, it doesn't mean that you have to trade these straddles or strangles. But in fact, one very big point which I have seen over the years, if a straddle like right now is giving a sell signal, which means there is going to be a pause, maybe a top in Nifty. That is the time where even in stocks, breakouts will fail. Maybe some stock has given a breakout yesterday or today, and it doesn't mean necessarily that it would have reacted well earlier. But since Nifty is at a resistance, as per the straddle charts, as long as that goes down, this breakout might fail. So this is one of the very big tools to identify where potential breakouts might not work, even in stocks.
Okay, thanks a lot, Abhijit. Appreciate you joining us today for this useful session. And it's not every day, guys, that we discuss option strategy. So thank you so much for tuning in. We'll make an effort to bring more and more of sessions like these from derivatives analysts. Thanks for watching Bloomberg Quint.